Something very different is happening with Bitcoin right now. As price pushes into new all-time highs, institutional capital is flowing in at a record pace. Abu Dhabi's sovereign fund has accumulated 4,678 Bitcoin, nearly 5% of its portfolio. Wisconsin's pension fund added 3,442 Bitcoin, about 1% of their total assets. These are not small, speculative positions. These are strategic allocations by major institutions, and they're happening right now, with Bitcoin at its highest levels in history. So that begs the question, are these institutions pouring in money at the worst possible time? Or is this unprecedented flow of capital into Bitcoin pointing to a much bigger rally ahead for this asset class? In our opinion, the evidence is beginning to point in one direction, that this wave of institutional capital may be laying the foundation for a much bigger bull market. And in this video, we'll walk through why that could be the case. One of the potential reasons institutions may still be buying even at all-time highs is because this bull market hasn't shown the kind of blow-off-top behavior we've seen in the past. Instead, this market has been marked by consolidation phases, followed by gradual legs higher. Pullbacks are more drawn out, and rallies are less aggressive, limiting the kind of euphoric behavior that often marks the end of the bull market. Look at this chart, for example. This move up here was the 2017 bull run. This one was the 2021 bull market. Both were fast, explosive, and ended with sharp reversals. Now, look at the current bull run. No vertical surges, no big collapses, just a steady grind higher. So, this bull market is unfolding more slowly and could naturally last longer compared to the fast, euphoric runs of the past. This is something we've talked about extensively in our recent videos. The current bull market that is taking place on Bitcoin is very different to anything we've seen before. There's one metric in particular that helps explain the shift in Bitcoin's behavior. That is Bitcoin's volatility index. This index measures how much Bitcoin's price fluctuates, on average over the past month. Higher readings means Bitcoin is experiencing larger daily swings, and lower readings signal more stable price action. For example, if the index is at 5%, it means Bitcoin has moved an average of 5% per day in the past month. Between 2011 and 2021, Bitcoin was consistently volatile, often moving over 9% multiple times. But over the past few years, Bitcoin's volatility has been in a clear downtrend. In fact, if we look at Bitcoin's one-year volatility, so the price movement in a year's time, it was around 100% in 2018, meaning the price could double or get cut in half in just a year. Today, that number has dropped to around 50%. That's roughly in line with major tech names like Nvidia, Meta, and Tesla. And that makes sense. As the market capitalization increases, volatility naturally declines. That's because it takes more and more capital inflow or outflow in order to move price. This brings more stable price action. This evolution in Bitcoin's behavior is what's making it more appealing to institutional investors. As Bitcoin starts behaving more like a maturing financial asset, the door opens for much larger flows of capital, which could lead to Bitcoin's market cap growing significantly more than it already has. This change in Bitcoin's characteristic means that more institutional capital could flow into Bitcoin and grow its market cap significantly more. And we're already seeing clear evidence of this shift playing out in the behavior of something called long-term holders. In the crypto space, long-term holders are investors who hold their Bitcoin for 6 months or more without ever moving or selling it during that time. That kind of commitment isn't easy. It means sitting through some of the most extreme price swings seen in any global asset class. But that's exactly what sets them apart. These investors take a more macro-level approach, focusing on value and long-term positioning. This chart here shows us what these longer-term holders have been doing with their Bitcoin going back to 2015. When this line goes up, it means they're accumulating Bitcoin, and when it goes down, it means these investors are selling their Bitcoin. After Trump's 2024 election win, Bitcoin rallied to new highs, and long-term holders took some profits. But after Bitcoin experienced a 30% correction, their behavior shifted. Instead of continuing to distribute, they started accumulating again. While not identical, this behavior is similar to what we saw during Bitcoin's correction in August. In both cases, risk assets sold off sharply, but long-term holders took the opportunity to increase exposure. Now, what's unusual today is that this accumulation by long-term holders is continuing even as Bitcoin has pushed to new highs. That might be a very constructive signal for Bitcoin. You see, long-term holders have a pretty strong track record of positioning correctly, for Bitcoin's next move. In 2018, as Bitcoin was finding its bottom. In March 2020, when COVID crashed global markets. In late 2022, when Bitcoin was down 70% from its highs. In each of these instances, long-term holders were aggressively accumulating, right when fear was at its highest. Then, as Bitcoin recovered and moved into new highs, these same holders gradually sold their holdings. In fact, the moments where Bitcoin's price action was the strongest and most euphoric were when long-term holders sold the most aggressively. While not perfect, their track record is the reason long-term holders are often referred to as smart money. And today, with Bitcoin behaving in the way a maturing asset should, it has led smart money to continue accumulating alongside institutional capital even at all-time highs. That alignment doesn't guarantee further upside, but it does significantly increase the odds. In the near term, though, Bitcoin is looking a little overextended after a powerful 50% rally off the April lows. Momentum remains strong, but the risk of a short-term pullback is rising as price extends away from its key moving averages. We think a retest of this $102,000 zone, which acted as resistance here and here, could be the first support area to watch. If price pulls back deeper, then there is strong support around $95,000, where the three key moving averages are beginning to curl up, indicating bullish momentum. In our view, any pullback into these zones could offer an attractive buying opportunity for potentially the next leg higher towards the 120,000 to 130,000 range. By the way, don't miss out on the 30% discount for our crypto trading membership. This deal won't last long.